Welcome to FYI, the For-Your Innovation podcast. This show offers an intellectual discussion on technologically enabled disruption, because investing in innovation starts with understanding it. To learn more, visit arc-invest.com.
ARK Invest is a registered investment advisor focused on investing in disruptive innovation. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. It does not constitute, either explicitly or implicitly, any provision of services or products by ARK. All statements made regarding companies or securities are strictly beliefs and points of view held by ARK or podcast guests, and are not endorsements or recommendations by ARK to buy, sell, or hold any security. Clients of ARK Investment Management may maintain positions in the securities discussed in this podcast.
From ARK Invest, this is FYI, the For Your Innovation podcast. I'm Brett Winton. With me, I have Lorenzo Valente. Lorenzo heads digital assets for us. All right, Lorenzo, tell us who we're talking about today and talking with, please.
So we were talking with Anatoly Yakovenko. He's one of the two co-founders of Solana, and Solana is really the first high-performance blockchain, smart contract blockchain that allows applications to be built on top of the network.
Are you bullish on Solana or bearish on Solana? There's a million level 1 blockchains launching. I can use Base. I can use any number of things to get my clearing and settling on blockchain transactions facilitated. How do you think about Solana's positioning here?
Yeah, I mean, we're definitely bullish at ARK, I would say. Solana, I think in terms of, it is like a high performance blockchains, but, as we were talking with Anatoly, like it is quite decentralized. Like if you look at the number of validators and kind of geography distribution, it's really way more decentralized than a lot of other competitors that we've cited like on the podcast. I would say also, like, we haven't touched on this, but I think just the human capital, like the quality of developers and applications on Solana is far better really than the other L1s that have been kind of built and launched like in the last 2 or 3 years. And you can see that, just on the ecosystem. So yeah, we're very positive. They'll continue to ship, as Anatoly said, like they have very exciting stuff coming up in the next 12 months. And if you look, on all the metrics and also a lot of the tokenization and stable coins, they've definitely hit, escape velocity and a lot of those metrics and kind of momentum and inertia. So yeah.
Yeah. So it's worth roughly $120 billion today as of this recording. Who knows what it'll be by the time you listen to this recording, but you can hear kind of some of the promise of why from Anatoly. So I hope you enjoy the conversation. From ARK Invest, this is FYI, the For Your Innovation podcast. I'm Brett Winton. We have a great show for you today. With me, I have Lorenzo Valente. He is a director of research for digital assets, and we have the founder of Solana. I'm just going to let you introduce yourself, please, because I'm going to screw up your last name again. Anatoly.
Hey, folks, I'm Anatoly Yakovenko. Pleasure to be here.
Yeah, happy to have you. All right. Solana is a public blockchain. People are probably familiar with it if they've listened to this. Tell us why Solana exists, what it does, how did you come up with it? Where does it fit within the spectrum of Bitcoin, Ethereum, the database on my computer, and what it's enabling today and will in the future?
Sure, the origin story. So in 2017, I had a side project. We were building GPU systems for deep learning, actually, just for fun with a buddy of mine. And we were using crypto mining to pay for the OpEx costs of deploying these GPUs. And I was trying to figure out, why are people paying me real money for this thing that does nothing? And, I was aware, of course, of crypto. Being an engineer in California, I think everybody was. And I had 2 coffees and a beer, Cafe Soleil in San Francisco. And that's not a combination that sits well with anyone. Didn't sit well with me. I was up till 4 a.m. and I had this eureka moment that there's a way to measure time instead of electricity in a permissionless, trustless, cryptographically robust way. Measuring electricity and kind of using that property is how proof of work secures itself or solves the Sybil problem. The Sybil problem is where everybody can fake their identity and create infinite number of votes or infinite number of posts and effectively spam the system. And there's a very brilliant paper for the Bitcoin white paper that describes proof of work and the Nakamoto consensus. It's very revolutionary. And I had this kind of huge idea that there's a way to measure another physical constant that you can't fake, time. And you can't use it to solve the Sybil problem, but I spent most of my career at Qualcomm as an engineer, and even though I wasn't working on protocols, kind of absorbed it through osmosis. And the first cellular protocol that people built was fundamentally using time, and it's called time division multiple access. And where this intersection between wireless communication and consensus kind of overlaps is that in Bitcoin, if you have two block producers that make a block at the same time, you get a fork. So you don't know the actual state of the network. You don't know which block is going to settle first. You're going to have a rollback. One of them is going to get dropped. So that's a noisy state of the network. So if you think in Shannon-Hartley theorem terms, that channel is dead right now. Information is not passing through. In radio, if two radio towers transmit at the same time or the same frequency, you get interference. Information is not passing through. That's a noisy state for that network. So you alternate by time and you prevent that from ever happening in radio. And I had this eureka moment. Oh my God, I think I can use this kind of kludgy thing that generates proof that time elapsed somewhere to build a clock that's global, that doesn't require any trust, and anybody can coordinate with to build TDMA for consensus. And why that was important is because if you look at channel utilization, how much information you can pass through Bitcoin is, you think of it as like just a simple message passing system. It's very inefficient. You can only stuff about 7 transactions per second, yada, yada. It's a very slow system. But as soon as you remove that problem of block producers ever colliding, you can use 100% of the bandwidth available to all those nodes. And you're still limited by the slowest node in the supermajority to get to agreement. But networks are really, really fast these days and getting faster, 2x every 2 years. You're standing on the shoulders of the most advanced technology and the fastest growing technology thing in the world, kind of Moore's and Nielsen's law, constantly improving bandwidth and latency. And I did back of the envelope calculation, and a 1 gigabit network, which is globally available in every city, would get you hundreds of thousands of TPS, which is, more than 10,000 times faster than what was available at the time. And that's really what kind of set off that bomb in my head, and I couldn't put it down, and got a bunch of friends from Qualcomm to join me, raised a bit of money, and yeah, here we are.
So the fundamental, if I were to try to explain to my 11-year-old how this works, everybody devotes computation against kind of a running clock so that when they finish the computation, this is how much time has elapsed. And they propose the block that's attached to it. And kind of the validators look and say, well, this is the next one that's in order, plus that transactions are valid. And so then, therefore, we're all going to agree this is the next one to get stacked. Did I get it wrong or no?
The only problem that we solve with proof of history is figuring out who goes next. So we're in a podcast right now. We can't all talk at the same time.
Well,
we could, but it gets noisy, right?
Lorenzo, go.
Yeah. So how most consensus algorithms work is they actually ask the network, you finished the block, let's all agree that you finished the block. Okay, you finished this block, everyone agrees that you finished the block, let's build the next block. And this process is extremely slow. And how radio towers work is they literally assign each tower like a 200 millisecond or whatever millisecond slice, and that's scheduled ahead of time. If you're late, you get dropped. If you're on time, you get to transmit.
So you all take turns.
Yeah,
it's like Ring Around the Rosie, or maybe that's the wrong game. But yeah, okay.
You get the duck goose. I don't know, but you get the idea. The difference is that you don't have to come to agreement before taking turns. It's all the turns are pre-scheduled, and you get to transmit optimistically, assuming nobody else is transmitting at the same time. And with radio, why this works is because FCC will send their goons out and it will shut down your tower if you're violating the protocol. In crypto, we can't do that because it's distributed, decentralized, anyone can participate. That means adversaries can participate in the protocol and you can't shut them down. So this cryptographic proof, this generation proof in Bitcoin requires energy and Solana requires real time to pass.
Okay. So somehow through some computational magic, the slot that I have, I'm proving that I'm occupying the slot that's been assigned to me, essentially. So to prevent Christian Slater from doing like the pirate broadcast radio station with all the
Correct.
illicit activity on it. Got it. Okay.
The property that is important out of this is not the proof, it's the fact that we don't have to coordinate and come to agreement or increase the difficulty to prevent collisions, is we can just transmit and use all the bandwidth. And 5 years later, or now I guess 7 years later, researchers have figured out that you don't need this cryptographic lock to get these same guarantees. And this amazing professor from ETH Zurich joined Anza, which is the company that's building the protocol right now, and is ripping away all my code. It's great. So proof of history is probably going to be gone next year, which is pretty cool to see. We've come full circle to like a very bleeding edge advanced consensus algorithm that doesn't require it, but has all the properties that we originally built that made Solana special.
So I've just spent all this time learning about something that's going to totally be obviated and boring our listeners with it as well.
You need to learn the Bohr's model of heliocentric atoms before you learn, Schrodinger's equation.
But so you famously said you think that blockchain should be invisible, as in the whole point here is like blockchains are kind of like slow and kludgy. And if people have to understand kind of the underlying underpinnings, right, then that means you're getting in the way of enabling the applications that matter, right? Is it enough for us to be like, hey, this thing works and it's going to continue to work most of the time? And so then therefore we're going to trust our transactions to clear and settle through it.
Yeah, I think blockchains are for businesses. It's a B2B system, like a database, like a retail user. My parents, they don't know what databases Apple uses, but they like Apple products. So I think ultimately a blockchain is a tool for businesses to go build something. So what is it, and like why we need them and why they work is finance is based on trust. And United States finance is extremely robust and been built over the last 100 years. And it was built at a time before the internet. A lot of the securities laws are based around your neighbor giving you a certificate to some railroad company and you paying a money for it and having a guarantee that that company actually exists. And that's the real certificate for that company, that kind of thing, right? And all these rules and regulations solve real problems, because when those problems were happening, people were actually getting scammed at large scales, and those rules exist because of that. And in this new age with crypto, you can solve all the same problems with cryptography and these public databases because of the security properties that they provide. So for a very simple example, right, if a company could issue their stock as on-chain, as a mint a token, right, and that represents their stock, and I transfer it to you, just like, when you go purchase something on the internet and there's this lock symbol in your browser that guarantees that your credit card numbers are not going to get stolen, right, during that transaction. You have the same exact cryptographic guarantee when I transfer you this token, but you can chain it back to the issuer, to the company, to their public key, and know that this particular company at apple.com actually created that token and they're claiming that that's their stock. And you have a full chain of events that gives you full fidelity of what you just bought without requiring laws or regulations, right? It's all purely cryptographically proven. So a lot of the stuff that's been built up over the last 100 years can effectively go away. And all those things, they solve problems, but they also charge for solving those problems. And all those basis points that get charged in the process of all that finance is effectively value leaking out of the system, right? We can remove all of that. We can reduce costs. We can make things even more robust, because while those systems are great, they're still run by people and they screw things up, right? So software eventually stops screwing things up.
When I think about Solana, you guys have really pioneered the high performance, blockchains, and focusing way more on execution than kind of settlement, right? Fast forward, I think you guys raised like in 18 or 19, like the seed round, like your first round. Fast forward to 2025, and basically like all the competitors right now, like all the L1s are, very much using that model, right? It's faster block times.
Yeah, you have to.
Yeah. Why do you think that's the case? Like we don't have anyone kind of going more the Ethereum or Bitcoin route. I'm not saying like proof of work, but clearly like all the competitors are using like a similar model today. Like why do you think that is?
In the early days, a lot of people fell into this trap that Bitcoin is extremely valuable and I can build Bitcoin plus plus, just Bitcoin plus a little feature, and therefore I should be valuable too, without understanding that I think Bitcoin's success is almost very little to do with technology and more to do with the social layer and like social aspect. And it's partly it is because it's so simple that it can actually attack a problem that's not even an engineering problem anymore, but truly like a fundamental problem of trust and money. And I think nowadays there is real value accruing to these networks. And the only way to accrue value to these networks is through execution, where you can charge a fee to, to bid on an asset be first, right? So you can charge priority fees. And the only way to do that is with a high performance system. So I think there's no way for somebody, I think, to build a better Bitcoin because it's not an engineering problem. I can build as an engineer, if you tell me, go build a better Bitcoin, I could build a simpler version, maybe with privacy and all these things. But that's not a product market fit problem. Like Bitcoin is succeeding despite its flaws and just because of its simplicity. There's no way for me to compete there. I think settlement is also very hard to accrue value in. And I think Ethereum kind of stumbled into its success. And it's hard to, me as like again, as an engineer, it's hard to build a better settlement system because it is such a also simple problem. Like once you do settlement, you don't need a lot of TPS and you have to charge very little because again, like I think at the end of the day, you're going to start competing with DTCC, which charges like 0.02 basis points on the value that it settles.
For my ignorance, like how are we defining settlement here in contrast to what's happening in higher throughput systems?
There's little priority for when the settlement happens in terms of time. Like there's no premium on time.
So you're willing to tolerate it taking however long before you're like, yes, I know for sure, unimpeachably, this thing is mine.
It's not that the user is willing to tolerate, it's the backend systems. Like a layer 2 is a perfect example. You make a transaction in base verifies that you got it, and the data that gets sent to blobs and the state root and the proof, there's a delay there, but all that stuff is going to happen eventually unless a very catastrophic fault happens. So for all practical purposes, you as a user, you've received your money, and you as a business, you've received your money. And Ethereum cannot earn any returns on that value transfer happening on base because there's no time priority when the blobs land or when the state root happens.
It's because it's all basically being batched up outside of the network and then cleared and settled back as a netting function. It's kind of like the way banks used to deal with derivatives. Like I have a derivative against you,
Yep.
You have a derivative against me. We're just netting the net balance, and periodically we post margin one way or the other, but everything else is happening off the kind of balance sheet.
It's a business that's between like a hard and a rock place. If you don't increase the bandwidth available for this batch settlement, people will just stop using it. They will use a different data availability layer. And if you increase it, like with engineering practices, just normally double it every 2 years, the price to use it is going to be commodity based. It's the cost of the bandwidth. You can't charge more than like 4x times the cost of the internet bandwidth, which is constantly dropping in price. So it becomes like a really, really hard business to scale up.
But on the other hand, like you said, it's kind of like DTC or, being that settlement layer can be, a valuable broad business, hard to displace. And here, if you have a high transaction throughput system, aren't you at the risk of me spinning up a database in the server, like under my
Absolutely.
desk here, and being like, I have a blockchain, just trust me, or
Yeah.
by the way, there's a lot of them spinning up. Like, how do you think about that?
All the money's made in execution, so everybody's competing for execution. So then how do you win there? So this is the Solana thesis, is that if we have a single giant atomic state machine that is as fast as physics allow, you're not going to get a better price in your own database, because the fundamental thing that's going to drive price for a user transaction is very similar to the database hotspot problem. There's no solution to it. And what that problem is effectively you have a chunk of memory, a chunk of state, like, a bulletin board or a piece of, think of it as like people writing down prices of their offers, and they're all writing it on the same chalkboard. The opportunity cost to write down that price on that specific chalkboard versus anyone else has a particular value. And if you move it somewhere else, that contention to be first, to be able to make that bid, is going to stay the same. Users are going to be exposed to the same kind of race to be first, to go write down their offer. So you can't lower the user price anymore, but you can capture it instead of me, right? So that's where the competition comes from. So you can build your own layer 2, call it base, and charge priority fees and sequencer fees. And those are competing with Solana, absolutely. They're also competing with Ethereum, because Ethereum also has that feature. And that activity moving off of Ethereum is why the fees on Ethereum have dropped significantly. This is kind of the fun part. And the thesis for Solana is that you're not going to be able to have a lower price than Solana. So we'll be able to be as good as anyone else, but we can also scale to cover the entire world, all the assets, all the possible markets. And the theory is that liquidity begets liquidity. And when you have it all in a single atomic state machine, the velocity of money and the capital efficiency increases dramatically. So you'll be able to do more with less. And the hope is that this just snowballs and continues growing.
But I mean, just at a very kind of crude and ignorant level, like laws of physics wise, it's kind of like the idea, almost like the Lightning Network concept, where it's like, there's no reason, it doesn't make sense for a transaction at a coffee shop here that it's like me to somebody else that's going to transact also locally needs to clear and settle all the way around the globe. Shouldn't there be some kind of like packaging up of transactions on a natural geographic basis?
From a computational engineering perspective, we don't need to. We can actually cover eventually cover all the coffee shop transactions, all the trades, all the Forex, all on the same giant state machine. We're bounded by parallel compute, not by sequential computation. And you get twice as many cores for the same dollars every 2 years out of TSMC. You get twice as many network cards, twice as much bandwidth every 2 years out of the network providers. So eventually you're going to get to a point where the amount of throughput this chain can handle can cover everything. So every 2 years, we're effectively expanding the capacity, and you can add more and more things as the demand grows. And demand is not going to grow exponentially simply because we're not doubling the human population every 2 years.
Yeah, but we might be doubling actual transaction activity as like AI agents begin to, clear and settle prediction markets. And
sure,
like you could have a mechanism by which kind of in fact, I would argue the promise of blockchains is actually the financialization of the world has to increase a lot, because there's a lot of dumb, inefficient stuff that happens because we're not kind of like abstracting into kind of like the information network in the way that we should. What we're trying to do here is actually create, it's not doubling humans, it's actually, doubling kind of like finding efficient pricing. So
the vast majority of transactions are going to be machine made. And that's already true today. If you think of like a single giant scaled business worldwide, like Google search is like a really good example. There's about 50 to 80,000 searches per second out of all the humans searching. And this was their peak, I think is actually lower now. That is not that much bandwidth. In terms of amount of capacity that the network needs to handle at the block layer, it's like 80,000 TPS is going to be roughly 200 megabits or something like that of bandwidth. So 200 megabits is available basically everywhere in the world already. And it's just a matter of cores and memory and like lining all those things up. Now you need capacity for all the bots and all the machines, all the market makers. But the way blockchains work is that I think one of the biggest innovations in blockchain is because it was able to evolve in this open environment where you could basically do anything. And people came up with a very simple solution to prioritizing transactions. And that's just based on priority fee. If you pay more, you get into the block. If you don't pay more, you get dropped. So if the priority fee drops below, let's say, 1/10 of a penny, or the floor price to get into a block is 1/10 of a penny, it means all the transactions that have less value than 1/10 of a penny get dropped. So even though there's demand for transactions that are like 1/100th of a penny, it's just the value of those things get lower and lower. And when you increase capacity, you can lower the floor price to get into the block. But the value of getting that transaction into the block is basically the priority fee. It just becomes kind of the noisy stuff that you don't care about. And you can see this with trading, like really effectively. Like NASDAQ handles like 1 million messages per second because they have this FIFO system by regulation that they have to accept every piece of data. But Solana handles about half the trades of NASDAQ today, I think, something crazy like that. So the amount of messages that get funneled in is very large on NASDAQ. Vast majority of them are cancels. It means just remove the order I just placed. And the amount of actual trades is maybe double of what Solana is doing today, even though Solana is able to do this filtering at the scheduler layer. It gets 1 million. We do actually sometimes see 1 million transactions being submitted to the block reducer all at the same time. It sorts everything by priority fee and drops everything below that. So you're dropping all the transactions less than 1/100th of a penny, and that's effectively the cancel part.
But doesn't that kind of illustrate the point that there could be, those drop transactions or transactions that somebody thought were useful, just not below whatever your floor transaction throughput rate is. And potentially you could like kind of batch and net off those transactions independent of the monolithic blockchain, right?
Sure. So you could run your data, like the goal of Solana is to handle the top 100,000 transactions by value that are most important ones. And if it achieves that, the next 1 million, there will be, just like Wikipedia has its own search, just like every website has their own little search engine, those searches just don't matter, right? The only company in search that matters is Google. So you end up with this power law in terms of value captured and value created going to, I think, a single chain or public chain.
Well, I'd argue the only search that matters is ChatGPT now, but that's a different conversation.
Yeah. So,
I mean, we have some examples like lately we've gone too far in terms of trade-offs to seek performance. Like, some of the more permission chains like, Tempo, Arc, or even Hyperliquid, right? Because you can always, make a set of validators that is smaller and kind of collocate in a geography. Do you think some trade-offs are acceptable, or we've kind of gone too far to just prioritize performance over other parameters, let's say?
This is the big unknown. I don't know. I have a bit of a religion about this. I kind of started coding in the 90s. I was a huge fan of Linux, and the ability for me to understand every part of the stack was really important. And I preferred to work on Linux over Microsoft simply because I had access to the entire stack. That's shaped how I think of technology. And my feeling is that if you have a system like Solana where it's fully transparent, anyone can go build their own validator, fork it, deploy it, and participate permissionlessly in every part of the stack, then the long tail of people are going to choose that over a permission system.
Right.
And the long tail is going to, I think, eventually win, just like Linux eventually won. Now, this is like kind of a bit of a religious bet, right? I don't know if that's going to be true because obviously there's tons of counterexamples to this. But I think finance specifically depends so much on trust and risk that I think it should tend and kind of towards the direction of verifiability and ability to control and have control over the systems that you're using over the long term.
Yeah. And isn't the whole point to like abstract everything into like a single set of values that you're like trading off against? Is there a future where it's like, oh, for this specific activity, I'm using this specific blockchain to clear and settle, and then I'm somehow bridging between blockchains. That seems to be what people are wagering. But
all blockchains have all the exact same feature overlap, except for Bitcoin because it's so constrained, but all general purpose smart contract platforms, so Ethereum and later, they can all do the same work, implement the exact same functions. The only difference is capacity and the kind of latency and throughput.
well, uptime also matters, right? Wouldn't like the
Sure.
criticism of Solana would be like, well, it's all great that this is working, but when it doesn't work, it really doesn't work. And that's really inconvenient for me, the end user.
Of course. So that's an engineering problem, right? You can solve uptime by doing all the same reliability kind of things that Ethereum has done, which is 5 different clients. So if one is down, the network still continues. And Firedancer is kind of a big effort on Solana to build a second client. But what's cool about Firedancer is that it's a modular architecture. So there's 3 other runtimes that you can plug into the Firedancer stack. We can effectively kind of get there to a similar amount of reliability as Ethereum.
What's the state of Firedancer right now? I think it's on mainnet. Like what percentage of the network is running like Firedancer?
There's, I think, 10% running Firedancer using the Agave runtime, but the network stack is fully Firedancer. And you can go and run the full version of Firedancer from, if you build it from source, run it on your own. So people are doing that too, but they're going through the audit stage right now, trying to make sure that everything is safe or secure from that perspective. And I think my guess is Breakpoints are going to announce a full version available.
Do you need like better hardware to run like Firedancer than like the kind of vanilla client, or?
Oh, no. So about the same.
Okay.
Speaking of hardware, you say Bitcoin is like unique and on its own. And I agree with that. I think every world will have one proof of work coin. So we'll have another one on Mars because you won't want to like be censorable on Earth with your transactions on Mars. So like ship some Bitcoin or some probably Dogecoin mining equipment to Mars is like on the first shipment to begin establishing the chain up there. But then you have kind of like Ethereum, which I think of as more decentralized than Solana, and Solana more decentralized than the next things launching down the stack. But then it's kind of like, aren't there always trade-offs that people can make? Like, how do you know that Solana's at the right spot versus kind of this next one versus this next one?
I don't think Ethereum is more decentralized than Solana. I think Ethereum's been around long.
But isn't that a controversial statement? I mean, isn't like to run a validator in Solana, it requires more money than to run a validator for Ethereum, right?
But that's an incentive. That's just an incentive issue, right? There exists a user, you can look at like my family and let's say we all submit a bunch of transactions. What's the cost of those transactions plus running a validator? And for some people, the cost of transactions is going to exceed the cost of running the validator because Ethereum is more expensive. So then the incentive is that you should actually use Solana because it's more affordable versus the Ethereum. So it depends on your usage. So it's a very subjective thing to say that Solana is less decentralized simply because the cost of the hardware is more. You're not paying for the hardware for nothing, right? You're getting a lower price to use the chain because of the hardware expense. So that the cost of the hardware is simply an incentive. But functionally, you can participate in every part of the network. And the more product market fit we have, the more people use the chain, the more nodes there are. And that's just a very simple relationship that you can see historically and kind of makes sense, right? The more businesses run Solana, the more demand there is to run nodes because they need to serve the data, they need to take transactions from the users and so on.
Does decentralization matter, or does the fiction of decentralization matter, or like the option value of decentralization? As in, you can have a concentrated network and you have some assurance that it's going to continue to work even under kind of like censorship pressure because you can induce more people to opt in, or people can like break up kind of the monopoly voluntarily because they know it's bad for the network otherwise. Like, is that actually a way to think about it?
I think it matters. And I think specifically, like, I think working backwards, like, why is Bitcoin so successful? The one reason that I can give to it is that if I own Bitcoin and something terrible happens in my local, like, sovereign state, I can go and settle it anywhere else in the world. So I can take it, pack our bags, move from the Soviet Union to the United States, like my parents did, and we can bring our Bitcoin with us, and then we can trade it in the US. So it is valuable from that sense. And the fact that anybody can basically settle it by just adding electricity creates those guarantees that it settles everywhere. You can construct those same guarantees now with like Tether and be very, very close to that. And I think had Tether existed, my parents would have preferred Tether when they were leaving the Soviet Union, right?
Right.
But like Bitcoin succeeded because it was first to create this global settlement guarantees. And I think it's very hard to dislodge that. And this idea of, I think, store value kind of took root. Now you start like dealing with different types of activity. Do you have different problems, right? I think if you look at something like Hyperloop, it's a fantastic product. It's also a perpetual exchange, which is a very complicated product. You can't really build a perpetual exchange smart contract that is completely immutable and has no Oracle dependencies and is completely devoid of any kind of external data input that could impact prices and things like that. So you as a trader, if there's no alternative when you're doing perps, whether you're using a completely trustless smart contract on Solana or Hyperliquid, the risks are the same. There could be an oracle that breaks all your execution assumptions at any given time, which is why I think Hyperliquid could succeed without any of those dependencies, because that particular product is just very, very hard to build to begin with and very, very hard to make significantly better improvements on execution guarantees to the point that they matter to traders and they would switch products. So it's all kind of a game of like being first to market with a product that's good enough, and then everything else, if it's only marginally better, it's just hard to compete there.
So then is it important from a Solana perspective? It's basically like to strike kind of like partnerships or reach out, make sure that applications are developing on Solana and specific applications and kind of like make yourself very friendly to them. Is this kind of like you occupy a vertical and then that becomes like at least a vertical that attaches to this blockchain and it's almost like business development motion?
I mean, first of all, I think decentralization is really cool from just an engineering point of view, because we can build these systems that are extremely fault tolerant. But I think the only way it survives is if that piece itself has PMF and is valuable. And the long-term vision for Solana and why it's attached to decentralization is because I think that is an opportunity to compete with centralized venues. And the way it kind of works is that you have NASDAQ, totally centralized, a bunch of co-located machines that are super optimized. They have like sub 1 millisecond matching, right? Microsecond based matching. It's extremely fast. The world as it exists today is like about 120 millisecond round trip time. So if an event happens in Singapore, like a container ship full of Apple phones sinks in front of the Singapore harbor, that's going to impact Apple stock. That news wire has to travel from Singapore all the way to New York to get traded on. So that 1 second, that's 1 microsecond, millisecond, whatever matching engine doesn't actually observe that event until that speed of light limit actually hits it and that information gets there, and then traders can go churn through it. If Solana is fully decentralized and we have block producers in every major city in the world, you can actually submit that newswire as a trade in Singapore to a block producer in Singapore, and it can start transmitting its block. And you have execution guarantees that block's not going to revert unless there's some Byzantine faults. So by the time that newswire hits the market in NASDAQ, you as a trader, when you look at price on Solana, the streaming price through those blocks on Solana or one on New York, it's exactly the same. So because of decentralization, if you actually spread the network out to where all the market information that's important is happening, and that should kind of happen automatically because I want to run my block producer there because I earn more fees, you can actually build a product that's competitive with NASDAQ NYSE, but it is open, it is permissionless, anyone can run it and participate in any part of the stack, and they fully understand all the trade-offs in terms of when the data arriving, all the stuff that people care about microstructure and trading, you actually have full control over it. Versus you have to pay NASDAQ a big pile of money and they put you in a box with a cable that's exactly the same length as everyone else, and you have to trade in this specific way. So I think this is the difference. I think Solana is a better product because it is like the Linux version of finance, and it can be a better product than decentralized versions but because it's decentralized and globally spread out. Now, this is kind of the science fiction future, I think. Maybe 5 years, maybe 10 years. And the path to get there is path dependent. If you don't have PMF now, you're not going to get to that like perfect world where there is Solana block producer in every major market in the world.
It makes me think about been reading Steven Pinker's new book. It's on common knowledge, which is a class of knowledge, which is basically kind of knowledge that you know and I know, and you know that I know it, and I know that you know it, extended recursively. And I think financial markets are common knowledge generators. And kind of like the idea that you can, it's not that you're instantaneously transmitting the knowledge, but you are creating the common knowledge and securing your time and space that like, this is when I created that knowledge, and then winning the rewards for creating that common knowledge is kind of like philosophically, it's very, very compelling, put it that way.
And I want to go back to this year. I think it was pretty interesting in the Solana community. The SAMD, I think 228 about the yield, the staking, like the emission schedule of Solana, basically. I think one thing that is very strange, I think, we've been in the crypto space for years now. And like today, if you look at even like smart contract L1s, the yield, right, that they pay for kind of staking and securing the network is just very, very broad in terms of range. Like I think Polkadot pays like 12%, ETH 3%, Solana 8%. Like, what do you think the end state will be? It definitely seems that, paying near like 10% is too much, right? Because like there's, inherently like quite a lot of inflation. Yeah, I don't know if we were public on this subject, but what do you think the end state will be for these L1s? It sure, like, it seems that we should all come to like some kind of not like, I don't know if it's 2-3%, but like it seems logical. Like, how should we think about that?
If there was no like taxes or kind of other losses in that flow, then inflation doesn't matter, because it is effectively numbers moving inside of a black box. So you as a user, you can, let's say there's 70% of Solana staked right now.
Mm-hmm.
If every user staked 70% of their coins and 30% were unstaked, then everybody's paying themselves the exact same amount.
Right.
Well, you're
in a proportionate mix. You're saying basically it's like the inflation is being dividended back to the users. It's not actually inflation. Yeah. Yes.
Exactly. So
you're essentially taking money from the pockets of people that are not staking and giving it to people that are staking, right? Like you're diluting.
But it's the same people, because anyone can move between that group permissionlessly. So you can
Right.
be a staker and an unstaker at the same time, because it's completely permissionless to move. And on Solana, it's really efficient. It takes like 2 days to move from between them. So it is effectively a black box. Where that black box starts losing money is if you're in a jurisdiction like United States, or you may have to pay taxes on those gains depending on like your specific situation, which is then you're charged capital, not capital gains, you're just charged short-term gain, like normal income gain taxes on that, and that's pretty inefficient. But that's not true about every jurisdiction, and not even true about every treatment in the US, depending on your specific situation. So assuming taxes don't exist, the inflation reward is basically kind of a dumb hook to force users to go participate in staking and picking validators so the network keeps running and making blocks. But it is effectively just numbers moving around a black box. The real yield in the network comes from, if you run a block producer, you need stake and you get a proportionate number of blocks based on the amount of stake you have. Any tips you collect But these tips don't have to be in protocol tips. You could literally have somebody give you like a stack of potatoes to include a transaction totally on the side. As long as that is proportionate to the amount of stake that you have, that's income, that's stake based. You would look at your Kelly optimized portfolio and decide between T-bills or do I buy more SOL to get more stake, to get more potatoes on the side, right? Like that is actual revenue that the network can accrue. And Blockworks, I think, has done the best job in terms of removing the inflation part out of the analysis and just looking at what is the real revenues that you can accrue if you were to go run a validator business on the network. Because that is, I think, fundamentally value captured by the network. It's me as a user to go submit the transaction. I have to do real work to get money, to go pay for the fee, and to give the chance for that value to you. I think 228 was an interesting exercise in governance. I think people do depend on the inflation as effectively a fee on unstakers and a way to subsidize long-term validator businesses. Because if you have no like the tips and all this other network activity, it's hard to predict what's going to happen next year, right? This year might be really good. Next year might be really bad in terms of market conditions. But if you have a constant stream of inflation rewards, then you can buy 12 years worth of hardware or allocate X amount of, work that you're going to do running a validator business. So it's this predictable income that I think is important. And the cost of all of running all these validators across the entire network, I think that's fair to count that as like the actual cost to run this network in terms of, if you're looking at red versus black, is the network in the red? Is it in the black? Look at all the operational costs and all the hardware costs, and you can say that's, if you didn't pay that, the network wouldn't exist. And if you didn't have any tips, there'd be no revenue. And look at both of them and just do a normal analysis.
A way we think about it kind of like at a very top 10 million foot view level is like, if you look at the overall financial ecosystem and look at total financial assets in the world, which we think are going to go to around $2 quadrillion by 2030. We don't have to make a heroic assumptions to do that, but you do have to like categorize what you mean by financial assets in some kind of way. But anyway, the global financial ecosystem strips around 3.3% into their revenues. Think about net interest margin or kind of what we're collecting for trading or kind of active management fees, all of that. So it's kind of a 3.3 take rate against $1 quadrillion is like quite a lot of loss to the real economy to achieve the risk transformation that financial entities provide. And where does that go? It's because I have to pay for JP Morgan's giant buildings. I have to pay for Morgan Stanley's investment bankers and their contract lawyers. And, and so then it's like, we're trying to shift that over to just falling to kind of like the compute costs and the costs people are willing to pay to get themselves into the transaction queue as the fee that's hopefully in excess of that compute cost. And then that should determine kind of the value of Solana. Ultimately, is there's some reservation demand to hold the tokens, but also it's like there's a yield based on that transaction fee amount, right?
Perfect. Yep. Nailed it.
What's in the roadmap like for the next 12 to 18 months? Like what are you guys focusing on? I know you have Alpenglow, you have multiple concurrent proposers. Yeah, well, what are you guys focusing on like for the next year?
So those are the two big things. So Alpenglow is this consensus update that rips a lot of my legacy code out. It's pretty exciting. So this was created by this consensus research team out of ETH Zurich. Awesome professor Roger and this team have built a really, really brilliant next generation version of consensus, which can give you full settlement guarantees in one round of communication, which is pretty crazy. I didn't know that would be possible, but with some assumptions that they make that are pretty creative. So what that tells users is that theoretically, in one round trip time of messaging around the world, which is roughly 120, 150 milliseconds, you can have full settlement guarantees. So execution, settlement are fully all squished into one. So as you make a trade, it actually settles at the same time, assuming there's no faults in the network. And it's tolerant, I think, to 20% to provide that one run with guarantees, which virtually never happens. So that's really exciting in terms of, I think, UX for users, UX for trading, payments, everything else is going to get faster and better. And then multiple concurrent proposers is that idea of how do we actually compete with NASDAQ? How do we provide a price discovery engine that is as good as a centralized system can provide? And the only way to do that without co-locating and putting everything in one spot, because that does fundamentally break decentralization, is to take advantage of the fact that you can have nodes in every part of the world that can ingest transactions locally. And that means the latency to include your trade can be faster submitting to Solana and Singapore versus sending it all the way to NASDAQ. And if we succeed there, then I think this idea that, science fiction financial system that is purely running on smart contracts with zero overhead, that it's all purely cryptography and everything is in one giant box with maximum velocity of every dollar is possible. So that's kind of why I'm still working on this, is because of that. This is, to me, like the most exciting engineering problem and fundamentally will reshape finance. And I think of it as like the Google version of finance. You have a single giant state machine that can cover the world. The same dollar can be in a market in New York, Zimbabwe, Singapore, in a single transaction that just atomically touches a bunch of these markets. That's the most efficient system you can build. I can't imagine anything faster than that. So why not?
What happens when 2 or 3 proposers basically submit a block like at the same time, right? Like how do you parse the transaction? Which one goes first? Like how do you handle that?
The rule of how to merge is known ahead of time and is deterministic.
Okay.
Then traders can basically adjust on that. And there's a bunch of different ideas being proposed, but the most simplest way is that the highest priority that's merged gets executed first.
Highest priority fee?
Yeah, by fee. Yeah.
So basically, I'm in if Singapore has a bunch of people that are willing to pay a lot more for transactions, then they'll be able to have their blocks have preference, basically. Does it weight off against time at all? Or
no, it's all happening at the same time. So there's this really cool paper on discrete batch auctions and as a fix to microstructure in NASDAQ, where instead of having this 1 microsecond matching in this constant arms race with market makers, you just have like 100 millisecond slice. Everybody submits their trades and you're on a batch auction of who gets to execute first within that slice. So the highest paying one gets to go first. And in this paper, they've shown that you actually get better price discovery and better prices for consumers, just everything's cheaper and simpler for market makers. So the goal is for this system where you have block producer in Singapore, block producer in New York, they both propose you have to resolve who gets to trade Apple because of that ship thinking news first. And whoever pays the highest fee to go first actually wins it. And the key part here for consumers, like for retail, like why do I care as a retail user, is because you as a normal user, you don't know the ship is sinking and you don't know how it impacts stock. You want actually the price to be reflected as fast as possible because that reduces risk in the system. And when that risk is removed, that means when you buy, you get a better price. When you sell, there's a buyer at the end of the side of it, which can be a market maker because information risk is reduced so they can put more capital at risk and earn more dollars. So ultimately, this benefits end-to-end consumers.
What's the timeline for that, Anatoly, like for multiple concurrent?
The timeline that I have a lot of confidence on is I think by breakpoints, Alpenglow should be on testnet. Like I keep asking the engineers if they're on track and they keep telling me they're still on track. And I think after that, MCP is going to be the big next high priority, big change. And my hope is we have like a prototype within like 3-4 months after that and then start merging it.
How are you guys thinking about quantum in general? I know like a lot of people have, very different timelines. I actually don't remember if Solana has like ECDSA, like public signature, like
Yes.
Like Ether Bitcoin. Like what's your view on that? Like should people just in crypto start worrying a bit more? I think people are, they're very confident that it's like 50 years away. What do you think about that?
I mean, 50 still, I mean, you have to understand that technology improves by 1,000-fold every 20 years. So you cannot conceive what's going to be 20 years from now. It's just very, very hard. So my guess is it's more likely in 5 years, we might start seeing some like early ECDCA, like very insecure versions of that. Like, so with fewer bits of security start being broken with quantum. The problem with quantum is it's just the errors scale so much as soon as you increase the computation that the error correction problem is just really intractable. If it's possible to solve it, it would create an incredible amount of wealth for the world, because like, I feel like, where humanity is today, we have completely solved Newton's physics. If it's like a thing you can eyeball in terms of speed and movement and mass, we have that computation down to like, we can build a 2-mile high skyscraper. We can predict like every kind of thing about like anything we can measure in like Newton's land. But as soon as you get to subatomic particles, just the amount of interactions between all the little particles involved is so incredibly high that it's intractable. And this is the big blocker for cancer, for diamond age materials, for all this stuff that, you think of science fiction, it's all arranging atoms. We're just so far from that. And if quantum actually works, I think we have a legitimate chance, I think, of moving humanity like into like the real science fiction land. I think that's awesome. If Bitcoin is the thing that forces somebody to go solve it, it will create 1,000 times more value than it's created today, even with its market cap at trillions. But I think it's at least 5 years away. Like, it just doesn't seem possible. Yeah.
Yeah, I would take the over. I mean, it's like there are certain technologies that always sit at this is 20 years away, and the roadmap always moves to the right, and it's hard to capitalize. It's hard to like motivate enough capital into even with like a Bitcoin honeypot sitting there to like actually execute on it, because the intermediate commercialization points are not really there.
The only reason why I would be more optimistic is because of, at least my experience with AI, is how quickly I can go from paper to prototype. It's just been accelerated by months. If I'm like coding, I'm a better coder than Claude, so like if I'm in the zone. But for me to understand a paper, it takes weeks, right? I have to read it a bunch of times and like really think through this, but I can just churn out a broken implementation that corrects it like in hours with AI. And that's pretty substantive change.
Yeah. So you're saying like the fundamental like rate of scientific advance across all fields could accelerate here, including quantum. And so you can pull forward the future faster. That makes sense. Okay. Well, we are
knock on wood.
Yes, we are, past time, but, Anatoly, thank you so much for sharing how you think Solana is going to pull forward the future in finance faster. It is really an interesting and provocative time for blockchains. I look forward to a faster financial future.
Thanks for having me. This was super fun.
This has been the For Your Innovation podcast with ARK Invest. I hope you enjoyed the conversation with Anatoly and Lorenzo. I think it is exciting to think about a financial future where we're all kind of clearing and settling on a single platform. Seems like a dry topic, but if you think about it, it's really the way in which humanity communicates across languages, geography, even across time with cost of capital. And so having a common language, a common mechanism by which those communications take place promises a lot of efficiency and human uplift. So hope you enjoyed the conversation. Please join us for the brainstorm and for ongoing FYI podcasts. You can rate and review us, and I encourage you to, on the podcasting platform of your choice. And we'll talk to you again soon.
ARK believes that the information presented is accurate and was obtained from sources that ARK believes to be reliable. However, ARK does not guarantee the accuracy or completeness of any information, and such information may be subject to change without notice from ARK. Historical results are not indications of future results. Certain of the statements contained in this podcast may be statements of future expectations and other forward-looking statements that are based on ARK's current views and assumptions, and involve known and unknown risks and uncertainties that could cause actual results, performance, or events to differ materially from those expressed or implied in such statements.
Decentralized finance, or DeFi, involves significant and evolving risks. DeFi platforms and protocols are often experimental, exposing users to the risk of rapid and substantial financial loss due to high market volatility, low liquidity, or flawed economic design. The technology underlying these systems, particularly smart contracts, can contain bugs, vulnerabilities, or security flaws that may be exploited. Even well-audited protocols can fail due to logic errors, implementation mistakes, or integration issues. Additionally, DeFi protocols are often governed by decentralized communities or token holders, and governance decisions such as protocol upgrades or changes to collateral standards can materially affect outcomes, risks, or user expectations. Finally, the legal and regulatory environment for DeFi is still developing. Changes in rules or restrictions can impact how these systems operate or are assessed. Users may find themselves subject to new obligations or experience disruptions in service, depending on how and where they engage with these technologies. In many cases, there are limited or no consumer protections, meaning users may not have access to insurance, legal recourse, or recovery mechanisms if assets are lost or inaccessible.